In this video, we're going to talk about what stocks Warren Buffett is buying in 2018. Stay tuned. Welcome back to Whiteboard Finance. My name is Marko, and I'm here to help you master your money and build your wealth. Today, we're talking about what stocks Warren Buffett is potentially buying in 2018, and I'm going to have a little bit of fun with this today. The way this came to my attention was that I read an article that Berkshire Hathaway has about $100 billion of cash on hand, and about $80 billion of that is earmarked for acquisitions and investments. So if you don't know, Berkshire Hathaway is actually Warren Buffett's holding company. So Berkshire Hathaway is a company that owns companies. So they don't necessarily need to be the majority holder, but think of it like a basket of stocks, kind of like your portfolio. That's what Berkshire Hathaway is. So it invests in companies with the best managements in place, incredibly strong balance sheets, strong brand recognition, and industry low-cost competitive advantages. This helps Warren Buffett obviously stay in the position of being one of the richest people in the world, but it also makes sure that their company's been profitable for a number of years now. So in 2017, Berkshire Hathaway made about 27 transactions, most of those being bolt-on acquisitions. So if you don't know what a bolt-on acquisition is, a bolt-on acquisition simply refers to the purchase of a company that merges into the division or a division of the acquiring company. So for example, Berkshire Hathaway has a subsidiary called TTI Inc., and what they did was they bought a South Korean semiconductor company called Changum INT, and they expanded into the South Korean market via that acquisition. So Changum INT obviously complemented some part of TTI Inc.'s business, and that's why they went with that acquisition. I wanted to have a little bit of fun with this because we obviously can't read Warren Buffett's mind, but we do have criteria that's publicly available online as to how Berkshire Hathaway makes their investments. So take a look at this screenshot. Their investment criteria is A, large purchases, so at least $50 million of before-tax earnings. This has changed, and it's actually, I think, 75 recently, but we'll stick with 50 for this example. Demonstrated consistent earning power. Business earnings have good returns on equity while employing little to no debt. They have a strong management in place. It's a simple business, so if there's lots of technology or things that they don't understand, they won't invest in it. An offering price is mandatory because they don't want to waste their time or the potential acquiring company. And also, the larger the company, the greater their interest will be. So they would like to make an acquisition in the $5 to $20 billion range. So Berkshire Hathaway ended the last quarter with about $100 billion with cash in the books, as I just mentioned. So I'm going to bump up that $5 to $20 billion criteria mark up just a little bit higher. The reason I'm doing that is because of A, they have so much money on the books, and B, they actually tried to make an acquisition of Kraft Unilever for $142 billion recently that actually fell through. It failed. So ultimately, I'm going to go through the criteria right here, so let's take a look at that. The first is pre-tax income of at least $500 million. So this satisfies the purchase requirement in step one. So Berkshire Hathaway set a threshold of $50 million in that criteria that we looked at, but expanding it to $500 million on the same ratio will give us a company size somewhere in between $33 to $133 billion to look at. Criteria 2 is having a PE ratio of at least 15 times each of the prior 3 years. So this satisfies the condition of having consistent earning power. Third is a return of equity of at least 8% for the prior 3 years. Additionally, the company's debt to equity ratio must be no more than 33% because they don't want to have a lot of debt. And you can see that this satisfies the condition of earning good returns on equity with little to no debt. 4 is the average tenure of management is at least 5 years. So given the 3-year performance of the metrics that we set, this helps ensure that the management has been doing a good job and it's already in place. Number 5, no more than 5 sub-industries. So what I mean by this is that Warren Buffett or Berkshire Hathaway mentioned that they want to have invest in simple businesses that are easy to understand. So I think that this satisfies that requirement. So the only piece of criteria that we can't meet is an offering price. The reason for that is because these companies aren't shouting from the rooftops, hey, we're for sale, or please invest heavily into us. So ultimately, that's a piece of criteria that we can't measure for or screen for. So when putting all these screeners into place, there were actually a dozen companies that met all these filters. So let's take a look at them very quickly. So you can see from this list that these are actually the 12 companies that we're working with. And I actually wanted to remove the ones that look overvalued. So I got rid of Actelion, Charles Schwab, Intuitive Surgical, and VMware. The reason I did that was because Warren Buffett is obviously a value investor, and he's not going to overpay for a company simply because it meets his criteria. So that leaves us with 8. So let's take a look at these 8. We have Adidas, BlackRock, Cognizant, Henkel, L'Oreal, Nike, Public Storage, and SAP. So now that we have our 8, now what? Well, Warren Buffett is ultimately going to buy what he wants, and he usually buys companies with large moats. So if you remember in my previous videos, I talk about companies having a moat. What a moat means in medieval terms is that you had the castle with the water around it. That's actually the castle's protective barrier, or barrier to entry, if you will. So when you think of an economic moat, or moat in the sense of talking about publicly traded companies or stocks, that's kind of like the company's shtick, or their barrier to entry against competition. So Nike has a very large moat in the athletic apparel industry. If you look at Geico, they have a pretty big moat in the insurance industry. So that's kind of what I mean by moats. So most of these 8 companies fit that criteria. So what was the point of this video? For me, it was a fun exercise to see if we can pick the same stocks as Warren Buffett in 2018 and beyond. So I think it's a pretty good sign if we invest in the same companies that he does, because he's been pretty successful, in case you haven't heard. So ultimately, I think it's a good exercise in stock screening and also staying disciplined to a certain investment criteria. A lot of us like to hear buzz about certain stocks and kind of just get that shiny object syndrome to where we're going to the next brightest, best thing. But I think it's good to stick to a set of disciplined rules. So let's see going forward in 2018 if Warren Buffett ultimately invests in any of these 8 companies. And if he does, you have to share this video with at least one person. That's my only obligation for this video for you guys. So thank you so much for watching. I really appreciate it. If you haven't subscribed or shared any of my videos, please do so below. You can share these videos with your friend or anybody else that you think would get value from them. Thank you so much and have a prosperous day. Hey Warren, it's Marko. How you doing? Good, good. Nothing, just relaxing. How are the kids? That's good. By any chance, are you investing in Nike in 2018? Hello? Hello?